I went to a financial planner with 18 properties, they would tell me to sell 12 of them. And my meeting wouldn't last very long. That's not because I know more than them. It's just that my preference is property. My preference is leverage through property. And that's the majority of my portfolio, but they're not taught that at university.
What would be some questions you would advise somebody who's looking to set up their accountant or financial planner? What should they be asking to make sure they're a good fit for the individual? And what would be some red flags?
Do they understand wealth? Are they investors themselves? So the red flags are people that don't chase rate, don't chase product. The important thing in the value and the money is in the structure and the strategy, not how do we save $250.
There's been properties that I've missed out on, and I've had great relationships with the real estate agent, and on the phone to me laughing, saying, mate, I had another buyer's agent, small agency come in, probably a 1 or 2 man band, and they've offered me 40K more than the next person coming through.
They're really basically doing the wrong thing by the customer.
You've potentially forfeited that first year or 2 years just straight away. You're playing off a handicap. Welcome back to the No BS Property Investing Podcast. I'm Julian, and today we're diving into something that separates the investors who build real wealth from the ones who stall out, your A team. You know, property is a team sport, and if you try to do it alone, you're almost guaranteed to hit dead ends, waste time, and make mistakes that not only cost you money, but can extend your investing journey by sometimes not only years, sometimes decades. So in this episode, we're going to be talking about the financial pillars of your A team. You know, that might be your buyer's agent, the broker, the accountant, and financial advisor. Who are they? What do they do? And how to know if you're the right ones in your corner. And as always, I'll be joined by Mark Davis to give us a finance perspective, because between us, we've seen just about every scenario under the sun when it comes to good teams and bad ones. So let's get into it. Mark, good to have you back again today. Bit of a different backdrop from where we normally speak. Where are you at the moment?
In Brisbane at the moment, Julian, up here where I live 3 weeks a month, and I spend the other week down in Melbourne. So one of my properties up here in Hamilton.
Oh, beautiful. Like you can see, it's nice and sunny. It's definitely not like that down here in the Melbourne studios today. So
always sunny up here, Julian.
I bet. Well, we'll jump straight into it. So obviously, when people are going out and they're looking about getting into the property investing, you know, in previous episodes, we've talked about setting goals and you know, understanding your why, but you can't just go out there and buy the property. You also need to have some experts in your corner, setting up a bit of a team behind you to help with the actual transactions and also your financial literacy along the way. So I guess what we want to unpack today is what are some things we want to see in that person in our quarter? What are some red flags? So Mark, let's get into accountants and financial planners. And I guess I like to group them together a little bit, not because obviously they do the same thing, but for some people, not everybody uses a financial planner. For others, sometimes their financial planner is also an accountant. But everybody obviously always needs an accountant because they've got to do their yearly taxes as well. But I guess from your experience, what are some things that, or a good, or let's call them green flags, that you like to see when you're setting up your team in terms of, you know, the accountant or financial planning space on your end, whether it be for you or clients?
It's a good point, Julian. I set up ALIC, as you know, about 15 years ago. And the first thing I did was I set up great teams around all our customers. And that's financial planners, accountants, stockbrokers, buyers advocate, us being the broker, etc. And having the best team who understands wealth and we're all heading in the same direction at the same time is a really critical part of it. So what I look for our business partners, and Ripehouse is a major business partner of ALIC from the property perspective, is his accountants have to be wealth-oriented, have to understand tax from a wealth management gearing, negative gearing perspective, not just doing tax returns. So that's from an accountant's perspective. From a financial planning perspective, it's got to be someone that understands property and doesn't just talk about super managed funds, insurance, etc., but actually builds property and gearing and lending into their plans. So when selecting a team, for those two professions, they're very important points.
Okay. And I guess when you're saying that in terms of being wealth orientated, has there been some, and I guess property orientated as well, has there been some kind of instances in the past where you've had concerns from clients or even from yourself from interactions where you felt like that person in their team wasn't the fit? I mean, I can give some examples on my end, but is there anything from your end that you've kind of seen before?
Yeah, many times. I mean, in most cases, you'll find that most accountants aren't wealth oriented. What I mean by that, they're a great accountant, they are a tax return accountant, they might be a commercial corporate accountant, but they don't actually understand the wealth and the investment side. And there's all different variances. And I'm not saying that in a bad way. It's just they're not wealth oriented. So they won't necessarily understand the gearing side, the ownership change, debt recycling, spousal ownership changes, all those types of various structures you can do from a wealth management perspective, because that's not their profession. Their profession is accounting in different areas. So getting it aligned and linked to what we do and what Ripehouse do from an investment perspective is really, really critical.
Yeah. And I guess from my side, touching on that as well, I think some of the things that I've seen for clients is, in particular, I think it's really important with any kind of investing you do, you understand the risk profile of yourself, the person you're doing it with. It needs to be really in sync. And sometimes you've got somebody who's really adamant, they feel comfortable investing in property. It's what they know, that's the pathway they want to go down. And then sometimes that individual is really heavily geared towards, they're all in on shares or other things, and they're trying to gear that person towards that instance rather than, I guess, tailoring it to theirs.
Yeah. And that's more coming from the financial planning perspective, where a lot of financial planners won't understand property or don't necessarily build property investing into their portfolio or into their clients' meetings. So they might be more biased to go a certain way. So we do come across those situations, and that doesn't mean they're doing a bad job. It just means they don't build in the asset class or the potential investments that our consumer may want to go down. And we find that situation a lot. And does that make them a bad financial planner? Not necessarily. Does it make them they're not as diverse, or they're really cookie cut? They come out of university to diversify. So if I went to a financial planner, Julian, with 18 properties, they would tell me to sell 12 of them.
Yeah.
And my meeting wouldn't last very long. Yeah. And that's not because I know more than them. It's just that my preference is property. My preference is leverage through property. And that's the majority of my portfolio. But they're not taught that at university. And they're taught diversification, and they will try and limit that. And a lot of them will say, you already own a house as a property in your portfolio, which is their principal place of residence.
Yeah.
So they'll say your asset balance is overbalanced in that level. So we'll go down a certain path, which is, in my view and your view, not necessarily the way to go.
Yeah, and I think if we were to reference it in sporting terms, like it's understanding the player you've got, right? If you've got a Rolls-Royce midfielder, trying to get them to play as a back pocket or a key defender might not be that profile. Whereas if you've got somebody, they're really comfortable in an asset class, they understand the risks, that they can afford it. Sometimes it's trying to tailor the strategy to the individual, because what I find for a lot of the clients that I've worked with over the years is there's lots of ways you can make money through investing, right? But it's more about the time element. If you try and push and steer a client into a type of asset that they're not comfortable with, the moment the market becomes unstable or they're just not having the best time or interaction with that asset gets pushed to the side and sold and moved on really quickly. And that's where you're not really making your returns. And I guess on the red flags or maybe questions, what would be some questions that you would advise somebody who's looking to set up, their accountant or financial planner? What should they be asking to make sure they're a good fit for the individual? And what would be some red flags you'd look to keep an eye out for? It's
interesting because we bring this up in every meeting that we have with customers in regard to what their accountant's like, what questions do they ask them, are they proactive in their responses about what you should be doing from a wealth perspective. So it's really making sure they're on the same page. Are we all heading in the same direction at the same time? Okay, so if you've got, like, the buyer's advocate Ripehouse in this case and us ALIC being the lender, if we're heading in the same direction, you have the accountant, the financial planner, the stockbroker, the estate planner, everybody on the same page, heading in the same direction at the same time. It's very powerful. So I'll ask a lot of questions in regard to what their accountant's like. What do they do? Are they proactive? Do they understand wealth? Are they investors themselves? So they're really important questions that I think when a customer's selecting their support partner, being a financial planner or an accountant, that they are on that page. We are heading in the same direction. We are talking the same language, but we're also independent, because I don't also believe in one-stop shops, which we've covered off in previous episodes.
Yeah. And I think to add on to that, I think a really important question to ask is if you're going into that space, you almost want somebody who's gone down that pathway themselves. So asking, are they investors in property as well? Because sometimes if they're not investing in property themselves, they're really kind of living their experiences potentially to their clients, which doesn't always paint the picture. So for me, I'd definitely add that one in there. And I guess from the red flag piece, is there any kind of big red flags? Or we could probably sit here all day, but what are some of the major ones that you would be wanting to keep away from?
Like you said, people that don't practice what they preach. Yeah. People that aren't wealth-oriented, who have, like, a lot of people come into the office and say to us, well, Mark, why should I listen to you? What do you do? What investments have you got? So the red flags are people that don't do what they are talking about or advising on. Yeah. And the other one is, would you go and speak to someone who's not that wealthy to understand about wealth? Okay. A lot of our staff were training up to be investment lending managers, and we get them into the property markets, they're investing themselves. So they're going to have customers sit in front of them moving forward and say, well, why should I listen to you? Okay. What did you practice what you preach? Are you walking the talk?
Yeah.
Yeah. And that's a critical part. So other red flags, accountants that are too broad in not understanding wealth in any form, who are just dealing with an accountant who does your tax return.
Yeah.
Okay, is a red flag to me. And then also financial planners who are very one-eyed in regard to just looking after your superannuation, your risk insurance, your managed funds, et cetera, not having a diversified portfolio. So they are really the main red flags that I see with most of the customers that come and come to us as a lending company to talk through their strategy.
Yeah. And I guess to add some layers from my side, which I see probably is getting more and more common, unfortunately, these days, is despite the royal commissions that's happened in the past, is if you've got a financial planner or accountant who's connecting you, and I guess all just being open and transparent. Obviously, we have a working relationship here, but you'd really just want to understand what that working relationship is. If they're connecting you to a builder or somebody who's building off-the-plan apartments, house and land packages, NDIS homes, you want to know why. Is it that because that's the avenue that they've gone down and they've made money on those returns, or is it because my LinkedIn inbox is filled with these kind of offers? Is it because that builder is trying to give them 20, 30K commissions for them to push their product onto their clients? So I think it's probably one of the biggest ones. I would think that you just want to find out why, if you're being referred to a certain partner, why are you getting any kickbacks or commissions? Have you used it yourself? Yeah.
Is there motive? So we'll only deal with companies that don't have motive, who don't take commission kickbacks, and there's not a reason other than just trying to look after them, like from your perspective on buying the right property or us to do the right loan. So if there's no commissions and no kick, this is why I'm really opposed to one-stop shops, because they're doing everything in-house and pretty much getting paid for every part of the transaction, the accounting, the financial planning, the estate planning, the buyer's advocacy, the lending, etc. And a lot of people like that, which I don't, for the reason that there's motive. Okay, yeah. So I agree with you. One of the biggest red flags is that they have hands in multiple pies and they're getting paid commissions for it, which creates motive, which creates a degree of greed, which can create problems. It's
also too, are they giving you, I guess, advice that's unbiased? Because it's biased, right? You're operating in that whole ecosphere of their little bubble that they're working with. So I think the way you've got it set up with how you work with clients today, like everybody's independent. No one's has any stake in each other's business. It's really, really important. But
they become a jack of all trades and a master of none. Yeah. So if I wanted to build accounting, financial planning, estate planning, brokering, buyer's advocacy, everything into my business, okay, I'm going to become quite average at each of them. So we've, when we set up our business a long time ago, the whole strategy was to become the best investment lending business we can in the country, okay? And that means staying away from those other things, but then bringing companies like Ripehouse in to our business to do the things that we can't do. That's been our pitch for about 15, 16 years, which can be costly because I got told many, many years ago when we set up the broker company that the only way you're going to survive is to cross-sell and sell insurances and to do all these other financial planning and accounting within house to survive. And I've been opposed to it from day one because I believe specialists are the way to go and what people want.
Yeah, I completely agree with you that there is I don't want a GP to cut me open and perform heart surgery on me. I want the cardiac surgeon to be doing that. Well, now we're going to dig into your profession now here, Mark. And yes. Obviously, we want to take our bias away. We just want to try and keep it really simple for the listeners. In terms of what should somebody look for? What does a good broker look like?
To me, a good broker is someone who, I am going to be biased from my perspective because we are an investment lending firm. So we're an investment lending broker. So this is not to go against brokers out there that are doing a great job offering rates and products and doing the right thing, which a lot of society need. But a good investment broker is someone who really understands leverage, understands gearing, tax, strategies, structures, risk profile of a customer, their comfort levels, how they sleep at night, how achieving their goals, understanding their goals, okay, and communicating that and joining the dots with all those professions. And how do you get that information in there to set up their loan structures and strategies correctly? That's what I believe a good investment lending broker is, which is a very different question to a standard mortgage broker who will normally go down rate, product, and service method.
And I've mentioned it before. I didn't mean it in a derogatory way, but I guess for me, when I say maybe a not so good broker is the waiter, the order taker. You've just come in and said, I wanted a $700K loan, you haven't got the why back in terms of what are we building towards? What are we working towards? And I guess touching on that a little bit more, what are some things that we need to be keeping an eye on? Like what are the warning light comes on if your broker's asking you certain things or pushing certain items on you? Like what are some red flags that the consumer needs to be aware of?
If you're serious about building wealth through property, you don't just need a loan, you need a strategy. And that's exactly what the Australian Lending and Investment Centre delivers. Australia's most awarded brokerage. They're not just looking at what you can borrow, they'll build you a holistic lending plan tailored to your long-term goals. We use them, we trust them, and so do our clients. So to find out more or to book your complimentary lending strategy session, head to the link in the show notes to connect with the team. Thanks for listening. Now back to the video.
Well, banks get paid commission, so they might be pushing certain banks for certain reasons. Okay, so I'm a believer that it doesn't matter what the bank's paying us. Okay, I don't even know what the commission splits are for the different banks, which I don't want to know because I want the right fit for the right product for the right customer. So that could be a bit of a red flag in regard to pushing down a certain path because there is some kind of motive. The Royal Commission obviously tried to get rid of a lot of that. There's still going to be some bias to go certain paths with like white labels and those types of things. And there's different products out there. Are there concerns or red flags that customers might come across as in regard to brokers refinancing just for the sake of refinance without the actual benefit or major benefit being there? I don't like the idea that people are refinancing to save $300 or $400 a year. I don't think the benefit's there to go through the work to do that. And obviously it's circumstantial, but you see a lot of deals written where there's no benefit for the customer or major benefit. That's a bit of a red flag out there that customers might come across when dealing with a broker.
Would you say that's the most common one? Like what would be the most common one that the average punter might come across?
It's about probably product comparison and believing that a new product that's going to return be a greater benefit to them that isn't really a major benefit. That's probably the ones I see. We are different. We just deal with investment lending. So we're fortunate enough that all investment customers come to us for structuring and strategy. They don't see rate and products as the major advantage or benefit. They value the other side that we bring to the table, which is more the strategy conversation, the regular contact. It's more sophisticated around tax and gearing and structures, and then we can put them around the best partners. So customers probably chasing rate is the biggest one out there that if I had to give advice to anyone out there and everyone out there, don't chase rate. Don't chase product. Don't go to the barbecue and say to your friend, what interest rate did you get? Okay. That's not the important thing. The important thing in the value and the money is in the structure and the strategy and the gearing and the wealth side, not saving 0.05%.
Yeah. And that's, I'd probably liken that to an investor chasing a certain rental yield because they want to feel like they've got the most bang for buck return on their rent when it's like, well, hang on. Is that market going to be the best growth market? Is that type of property you're buying in terms of condition, like you've sacrificed to get the better yield? We'll look at the quality of the property and the maintenance and the upkeep. And I guess on your side and seeing it firsthand, sometimes chasing that rate has meant that the clients sap their borrowing capacity. They can't go to the next lender because they're already there, right? Or they're not structured correctly from a tax perspective. So the money that they're saving now with that extra 0.1% interest rate, well, they haven't structured it anyway. So they're actually losing it on the back end when it comes tax time. Is that what you're kind of alluding to there?
Yeah, absolutely. And I mean, it's in the psyche of the average Australian, isn't it? Like it's what rate did you get? Okay. My answer to that, who cares what rate it is? Okay, it's just got to be competitive, right? Because the value is in how do we turn $500,000 into $1 million?
Yeah.
Not how do we save $250? Yeah. Are we here to save to make $500,000, or are we here to worry about $250? And the average Australian will chase the 0.05% discount and think that's a benefit. When in actual fact, to me, it's a cost. It's a time cost to process the loans to get that over, to save that money. But the real benefit that is being missed. The real benefit is in the wealth side, the structure side, the strategy side, the tax side, the gearing side, the ownership side, the re-gearing side, and the reduction of the non-deductible debt side, which is the massive part. Because if you can get rid of that home loan debt of non-deductible debt down quickly, the savings is enormous. And then if you can utilize those funds that you save to buy 2 or 3 or 4 investments, you get that leverage effect. And that's where you make money. You don't make money through 0.05% discount making you saving you $250.
Yeah, absolutely. Now, last one, and obviously full bias here. Obviously, podcast is sponsored by a buyer's agent, acted as a buyer's agent. I guess transparency to the listeners as well. I'm somebody who's used a buyer's agent early on. You've used buyer's agents in the past as well, Mark. I guess from your side, really open, transparent to people listening, Mark is a huge advocate of his clients using buyer's agents in terms of, just like we've talked about in the podcast today, really, really big on specialists. But what are some things that maybe instant turn-offs when you see a buyer's agent? And I guess on the other, these guys are switched on. And then on the opposite side to that, what are some things where these are the people that you need, your clients, or as somebody who's listening, trying to find the right buyer's agent to work with, what should they be gravitating towards?
It's a good question. We gravitate to Ripehouse because of what you bring to the table. But when people are choosing a buyer's advocate, they've got to be choosing a wealth person that really understands data and understands the immigration numbers, population numbers, infrastructure spend, the reasons why you buy in certain markets, the reasons why you get out of certain markets, etc. So examples, if you look at the apartment market in Melbourne for the last 15 years, under 70 square metres hasn't gone up since February 2010. So they don't have the right data. They're going to put you in markets that aren't going to perform. So customers out there should be looking for buyers advocates who have that data, have the best data in the market, have that information, are ahead of the game, know where to buy and what to buy and when to buy it and how much to pay and when to walk away from it. And then the other part I find really, really important for our business is our buyers advocates have to know when to sell. So when's the exit strategy to allow us to reduce non-deductible debt, to improve situations for customers, to improve cash flow, which loosens the noose for the customer to be able to run their household properly. So they're really the major things that I want my clients to ensure they've had when dealing with a buyer's advocate.
Yeah. And I think to add layers on top of that as well, in terms of, I think there is still the adage where there'll be some buyer's agents out there that will be telling their clients, hold on to your property forever, pass it on to children. And that doesn't always make sense. Yes, in some instances, we might want to hold the property for a very long time because in their unique circumstance, it makes sense. But if you've got bad debt, if you're heading into retirement, you need to replace your income now. There's got to be ways out. It's not this mentality of hoarding onto property. So it's about shaping and molding. But I think the big one for me that I want to see from a buyer's agent's perspective, if I'm what made me use the business originally as a client many years ago, is that I think runs on the board's a really important one. I don't know if you'd agree with that, Mark, but I think, there's been a lot of buyer's agents out there that's only really popped up kind of post that COVID time. There's some reasons for that. There's some RTOs that are just churning them out. Yeah. So for me, I'd like to see runs on the board, and I would really like to see that my buyer's agent is also a full-time buyer's agent. Knowing that my buyer's agent that I've just hired off a Facebook ad and he runs an IT program 8-12 hours a day, and on the side hustle, he's buying properties. I don't really know if he's putting in the time and the effort speaking to agents, doing all the relationships. So that's probably a big one for me.
Performance, Julian, is massive. And we will only get into bed. So LIC are very selective on who we choose to work with. And Ripehouse, we started work with about 3 years ago. And if the runs aren't on the board, the proven performance, we measure every growth rate on every property, every buyer's advocate's purchased for the last 15, 20 years. And if that's not there, and there's not 35% growth on an asset over 4 to 6 years, it's actually questionable whether we should be buying that asset after you take into account purchase costs, sale costs, running costs, capital gains tax. And then if you take all that into account, if there's not 35% growth, it's questionable whether we should be going down that path. So performance is the number one, and definitely what they should be looking into.
Yeah. And I guess probably the last one to end the episode in terms of red flags. What's the biggest red flag from a buyer's agent from your side?
Clients who have one of the biggest red flags has been people buying apartments in Melbourne for the last 15 years.
Yeah.
Okay. So any buyer's advocate doing that, and we are a lending firm, so we aren't the property firm to give advice on this, but all the professionals we speak to and talk to on a weekly basis haven't been buying apartments in Melbourne since 2010. And I'm not saying that's not something we can do moving forward, because the market's going to turn, and I believe Melbourne's turning from what we understand, but that would be the biggest red flag out there. And the other one is overpaying, not really negotiating and doing the job for the customer. So a great buyer's advocate should be out there getting properties that probably aren't as accessible to them under normal formats, and then being able to negotiate that price. But also the main one is valuing that property and getting the true value on the property, and then understanding what the growth in that property is going to be. So
it's funny you mention that, because to add to that, I can tell you firsthand, there's been properties that I've missed out on, and I've had great relationships with the real estate agent, and they've literally, on the phone to me laughing, saying, mate, I had another buyer's agent, small agency, come in, probably a 1 or 2 man band, and they've offered me $40K more than the next person coming through. I'd be stupid. Like, even if you offered me that money for this or to go above that, as our relationship, I'd be telling you it's crazy. You're not taking care of your client. So there's some people who absolutely operate in that way out in the marketplace.
From your perspective, that would be very frustrating, because you know what the true value is, you know what it can do. Yeah. And those advocates are just getting in there and buying, not really understanding the true value or the information around that, the data around that property and market, and overpaying in the hope that they know it's going to go up. But they're really basically doing the wrong thing by the customer by paying 40K over.
Well, I think it also, in terms of even if that property grows, if you've overpaid 5-10% at the beginning, you've potentially forfeited that first year or 2 years just straight away. You're playing off a handicap, and then it's kind of no different from going out there and working with the buyer's agent who only wants to buy in one market, because let's just say he's the Gold Coast buyer's agent. Well, great. We could go out and buy in the Gold Coast in 2010, but that market didn't do anything for about the next decade. So it might be a good place to invest in right now, but it's also about what's going to get that client the return. Because if we sit there and we do nothing for a decade, all of it is that you've gotten 10 years older. That's probably the position it leaves you in.
Well, the buy price is the critical part, isn't it?
Yeah.
It's a critical part. We can all buy property. We can all understand what markets are going to go up eventually, and we can get that data out there. But negotiating and getting it for the right price and understanding that price is a critical element of it.
Absolutely. Well, Mark, it's been a pleasure today. So there you have it, guys. The financial pillars of your property investing A-team. Your buyer's agent, your broker, your accountant, and your financial advisor. Get those 4 right, and the journey becomes smoother, faster, and way more successful. Get them wrong, and you'll spend years undoing mistakes. Remember, property is a team sport. Surround yourself with the right people, ask the right questions, and you'll set yourself up to win the long game. We'll catch you all on the next one. Bye for now.
Thanks for watching. If you want to avoid underperforming acquisitions, grab our free suburb performance report below. It's packed with data we use every day to guide our clients.